But anyway, this is a 200 simple moving average that you'll see on Bloomberg, that you'll see on Reuters, that you'll see on CNBC, that you see at FXDD as well. But the 200-day moving average here, what happened here when the market broke above the 200-day moving average? The market moved higher. Market moved above it, closed above it, found support against this level, and moved higher. And you can see that there was other times here when it broke, it moved absolutely higher. Now let's take a look at this break from a historical perspective and see if this level is significant, or if you think it's significant. And what we see here is the market trending to the downside here, and this break came in around the 128. Actually, I think it was like 20. It might have been 33 at this point. Down here, it's like 23 and 22. So 33, let's just call it 33, but wherever it breaks, it breaks. That's the 200 bar moving average. And this is the first break of the 200-day moving average since October 28th, 2011. So for the entire year, the market stayed below the 200-day moving average. So is that significant? Yes. Now let's put in another simple moving average. And you see this moving average, or this trend line here? Does this look familiar? Yes. This is the same trend line that started the move to the downside in May. And it comes back into play right here. The market that trend line comes in about 10 pips above that level. Is that significant? Is the break above that trend line significant? Break above the 200 bar moving average significant? Yes. Visual, simple, look at it. So what does it define risk against these levels? Well, if the market should break above the 33 level and break above the 43 level here, the defined risk is, I don't know. How about that? 28.10. So do you have to risk a lot on these trades when you see something visual, something that's significant? No. In an uncertain environment, take the clues from the market and let's see where it goes. And if it takes you out, all right, let it take you out. You lost. That's part of trading. Not all these things work, okay? Now, not all the time the market is going to do what you think it should do. In fact, over here it doesn't do what it thinks it should do. We don't find support here. It breaks actually below that line right here. We'll get to that in a second. So now one of the things that you have to do as a trader is you have your entry, but you have to then have targets of where you're going. And so I'm going to introduce a third tool here. A third tool that traders tend to use, which is visual, simple, logical, defines risk, is a Fibonacci retracement. So if I go back, here's our levels that we just traded in this uncertain environment where the market doesn't know which way it wants to go, or it's starting to trade in an uncertain environment at this point right here. What I want to know is where are we going? So if you take the high and the low here, and you do your due diligence in your trading, again, use tools that the market's going to follow and stuff. And if you take this high and the low here, and you apply a Fibonacci retracement, you can help to start to define targets of where you're going, especially in corrective moves. And this is a trend, and this would be a corrective move. And these targets help define areas where you to take profit or even go the other way in uncertain markets. So if I were to apply a Fibonacci from that high to this low right here, you can see that the 38.2% retracement comes in at the 131.48 level. So when the market broke through this 200 bar moving average and the trend line here, the market we had our stop down here, and the market started its rally. And it wasn't but 3 or so days later where the market moved from this 128.33 level to 131.67, right around the 131.48 level. Now, we went above the 48 level, yes. The market should have gone higher above the 48 level because it broke through the 48 level. If I move this chart way over to the right and saw the market breaking through the 48 level, what would I be thinking? I would be thinking this market's going higher, but it didn't. It's failed up there. Remember, one of the things that you look for in markets that are uncertain, perhaps with lots of potential for news to change, is for failures. And this market had a close or moved above that 48 level, failed, or didn't close above that level. And the next day we moved above it again and didn't close above it, and the market started to move to the downside from that part. Clue. Look for the clues. Look for the little failures. Even a little failure is just that much. That's clue to the downside. Now, when the market came down here to the bottom here, we found support against what? The 200-day moving average, and the market moved up a little bit and then came down. And you actually, moved down a little bit below that line. It actually moved about 19 pips below the line, just like it moved 19 pips above the line here. And the market came down to the 03 level and failed again. And what did that failure cause? It caused the market to move back and forth, up, and down. And so there are certain things that I'm going to go through now that you want to look for in an uncertain environment. Little clues along the way, little technical clues that you can use, the tools that you can use that will help define the trend. And if you see these things start to hold, if you see the clues come to fruition from the technical levels, start to believe them. Start to think that you're not the only one that is seeing it, okay? So let's take a look at failures, okay? Failures of key technical levels in uncertain markets can provide reversal clues. So we looked at this high right here. This is this is bringing it in closer here, the 48 level. The market moved through that 48 level and failed up there. And then the market started to come down. Failures are clues. When the market came down to the 200, we found support against the 200. We found support against the 200. Each of these times the market bounced. We're trying to find support with market bounce, and then the market fell through the level. So if you bought here and the market moved higher, you had some profit in the trade, but eventually, if you're just using this 200 bar moving average, you'd stop yourself out below the 03 or the 23 level. That's where the level came in. And the market went down to 03 level, but closed back above it. Look for those failures, just like you look up here. And when you see the market start to move higher, that's an opportunity to get back in the market. Get back in the market, see the failure. Understand that failures are important in uncertain environments because bias changes very quickly. Bias changes. So look for failures in uncertain markets, and especially at key technical levels. 38.2, key technical level. 200-day moving average, key technical level. These are levels that you have to pay attention to. Now over here, when we had the election occur, and the market failed to stay below the 200-day moving average. On this day, we came and tested the 200-day. Then we moved below. Then we had the election, and the election results came out. What were the response to the election? Sell the dollar. So the euro went up, and where did we go? We went up to the underside of this trend line, actually. And the market failed. The market failed above that 200-day moving average, and that started to move to the downside. We're up here now. Now I know we're higher off of this level, but and in fact we went a little bit lower here. We went down toward the 61 level here. But the point is, look for failures. Look for failures. On the election day, when the market failed up here, it actually started and we started to move back below the 23 level. It actually started to move sharply to the downside. Other things traders look for using your key technical tools: 38.2% retracement. 38.2% retracement slowed the move up here. It slowed the move up here. We got to 43 here. The market found sellers, early sellers against the 48 level. Market sold off. That's a key level. Look. Not oftentimes, look for key technical levels that, maybe head and shoulders formations, maybe things like gaps, okay? Little technical clues that don't come along very often, but when they do, you have to pay attention to them. And there was a gap back in May when the market peaked at the 82 level, 132.82 level, started to move to the downside here. We actually had a gap in the market here that was in between, what was the 79 level and the 65 level. Market remembers that, folks. Market remembers that gap. Believe me, it knows that gap exists. In fact, I had a trader tell me at the Las Vegas Traders Expo that he went long right here, because he thought that gap is going to be filled, and he saw the market starting to move up here. He went long, and he lost and lost and lost. Finally got stopped out of his position, and he told me, he's like, I couldn't tell my wife. I couldn't tell my wife what I did. And he got lucky. He came down to the 50% of the euro's trading range at the 121.31 level. This is what he's relaying to me. And he said he bought right here against that 31 level. Against that 121.31 level, and he was able to make back, to the grace of God, most of what he lost. So anyway, the point is, the gaps do matter. The gaps are remembered. The gaps are remembered, and that gap was remembered here when the market broke through that gap and we started to shoot back to the upside. It also was remembered here. It was remembered here. It was remembered here and here and here and here and here and here. I don't think it's an accident that the market moved above the gap came down to the gap, found support, and when it broke through the gap here, came back and used the gap as resistance to sell down here. I just don't think that that's a coincidence. I think the market remembered that level, remembered that key level.